Hey everyone, and welcome back to the channel where we demystify the markets and uncover unique opportunities. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and the mechanics behind a potential short squeeze. We're going to use a real-world example that's caught our attention: Global Interactive Technologies Inc., or GITS. This isn't just theory, we're breaking down specific numbers and factors directly related to GITS that put it on our radar. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's kick things off with a quick look at our focus company today, Global Interactive Technologies Inc., traded under the ticker GITS. This company operates in the communication services sector, specifically within internet content and information. GITS, through its subsidiary, is a technology-focused platform company based in South Korea. Their primary offering is Filings, a digital fan engagement platform designed to support online fan communities, content discovery, sharing, and user interaction. It's a niche, but growing area. Right now, GITS has a relatively small market capitalization of just $7.01 million. Should chart GITS daily. Looking at the recent price action, it's been a bit of a bumpy ride. Today, the stock is showing 0.0% change, but over the last 5 days, GITS is down 28.78%, and looking at the last 30 days, it's down 7.21%. Volume-wise, today saw 45,300 shares traded, which is actually below its 30-day average volume of 86,076 shares. That gives us a relative volume of about 0.5 times the average. Low volume can sometimes mean price movements have an outsized impact. What is cost to borrow and why it matters? So, what exactly does it mean for a stock to be hard to borrow, and what is this cost to borrow we keep mentioning? When investors want to short a stock, they first have to borrow shares from existing shareholders, usually through their broker. They then sell these borrowed shares in the open market, hoping the price will drop so they can buy them back at a lower price, return them to the lender, and pocket the difference. The cost to borrow, or CTB, is the annualized fee that short sellers pay to borrow those shares. It's essentially interest on the borrowed stock. Why does it matter? Because a very high CTB indicates that shares are either in extremely high demand from short sellers, or, more importantly for our discussion today, they are very scarce and hard to locate. When you see fees climbing into the hundreds, or even thousands, of percentage points annually, it's a clear signal that borrowing supply is tightening significantly. Yes, fees can absolutely exceed 100% on an annualized basis, reflecting the intense scarcity and demand to short the stock. Why the stock is hard to borrow right now. This brings us directly to Global Interactive Technologies Inc. It has appeared on our hard-to-borrow screener for a very compelling reason. Its annualized cost to borrow fee is an astonishing 932.3%. Highlight CTB on screen. Think about that for a second. If you're shorting GITS, you're paying nearly 1,000% of the stock's value annually just to hold that position. This makes GITS incredibly expensive for short sellers. While we don't have CTB momentum data or the exact number of shares currently available to borrow, that 932.3% figure speaks volumes. Furthermore, GITS has an estimated float of just 2.4 million shares. A small float means there are relatively few shares available for trading in the first place, making it even easier for supply to dry up when demand from either buyers or short sellers intensifies. Our internal composite squeeze score for GITS, which combines factors like CTB, float, volume, and technical setup, currently sits at 42.5 out of 100. This score indicates that while it's not an immediate screaming squeeze candidate, there are certainly factors in play that warrant close observation. It's crucial to remember that a sky-high cost to borrow doesn't guarantee a squeeze. It can also signal that short sellers have very strong conviction that the stock will fall further, and they are willing to pay a premium to maintain their position. Squeeze mechanics explained. So, how does a short squeeze actually work, especially with a stock like GITS? Imagine you're a short seller betting against GITS. You've borrowed shares, sold them, and are now paying that eye-watering 932.3% CTB. Now, imagine GITS starts to move up, perhaps due to unexpected positive news about its Filings platform, or simply an increase in buying interest. As the price rises, your short position goes against you. Your broker might demand more collateral, known as a margin call. At this point, short sellers face a tough choice: either put up more capital or, more commonly, cover their short position by buying back shares to return them to the lender. If many short sellers are forced to cover simultaneously, they all rush to buy shares. With a limited float of 2.4 million shares for GITS and potentially even fewer shares available for borrowing or purchase, this sudden surge in demand can rapidly drive the price up. This upward movement then triggers more short sellers to cover, creating a positive feedback loop or squeeze. The hard-to-borrow aspect simply intensifies this, as the scarcity makes it even harder and more expensive for shorts to locate shares to cover. Dilution risk check. One critical factor that can impact a potential short squeeze, even with high cost to borrow, is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can create an overhead supply that can absorb buying pressure and negate any squeeze momentum. Imagine a company trying to raise capital by selling millions of new shares into the market. This new supply can easily depress the stock price. For GITS, we ran our checks. We found no recent diluted SEC filings such as -1s, -3s, or 424 BS in the last 90 days. This is a positive for a squeeze thesis because it means there isn't an obvious source of new shares from the company itself that could flood the market and dampen any upward price movement. Additionally, we found no recent reverse split for GITS in our look-back window, another factor that can sometimes complicate short squeeze dynamics. Let's take a quick moment for another important reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're keeping an eye on GITS and its hard to borrow status, what should you be watching for? First, keep a close watch on volume. Show volume chart. GITS's current daily volume is quite low, averaging just 86,076 shares over 30 days, and today it's even lower at 45,300. A significant spike in buying volume, especially on green days, could signal increased interest and potentially the start of a squeeze. Second, monitor the price action. Despite the recent declines, look for a sustained reversal and high lows. Third, keep an eye on any news related to Global Interactive Technologies Inc., particularly updates on its failing platform or any corporate developments out of South Korea. Positive catalysts could ignite buying pressure. Finally, while it's harder to track directly for retail investors, watch for any public data on shares available to borrow. If this number starts to visibly shrink, that's another key indicator. Remember, high CTB does not guarantee a squeeze. Short sellers are paying that 932.3% for a reason, and they might have strong convictions that GITS is heading lower. Global Interactive Technologies Inc. GITS presents an intriguing case study in the world of hard-to-borrow stocks, primarily driven by its staggering 932.3% annualized cost-to-borrow fee and a relatively tight float of 2.4 million shares. While recent price action has been negative, these factors, combined with no immediate dilution risk, place GITS squarely on our watchlist for potential short squeeze conditions. Always approach these situations with caution, do your due diligence, and consider all angles. If you found this breakdown of GITS insightful, please give this video a like, subscribe to the channel for more unique deep dives, and let us know in the comments below what other stocks you're curious about or if you have any questions on short squeezes. We love hearing from you.